Are you wondering why this current administration is asking the Fed to reduce interest rates? Wonder no more. Are you aware that $9.2 trillion is almost due? So sit down, relax, and enjoy while I take you through the risk, what is at stake, how the Fed has a tight walk around this entire thing. Listen, relax, and enjoy because I got you. Welcome once again. My name is Bibi Ofiri. For those of you that have not watched my video on the US national debt, I would advise you to pause on this and go to that video so that you understand the conversation that's been going on. But currently there's something that is going on. There's going to be a financial wave coming in just less than 1 month, and no one is talking about it. Even the radio, the TV, no one is saying anything about it. All we are hearing is the Dutch unemployment. We're hearing the tariff. We're hearing all sorts of things, but no one is really talking about the big deal, which is $9.2 trillion of the US debt is getting due in June. And why this is very significant, let me break it down. The US debt is currently at 36.2 trillion. That is, the 9.2 trillion that is almost due in a month or so. It's about 25% of what the US owes, which is 36.2 trillion. It's significant, and most of them were at a rate below 2% interest rate. And the reason why this matters is because it's coming due very soon, and it's coming during a period whereby our interest rate is very high. We are currently at a 4.5 to 5% interest rate with the Fed. That is significant because let's put this into the right perspective. It's just like you buying a house and you're about getting foreclosed, and the only thing you can do is either you sell or you refinance. Now, that's the problem that the US debt is facing. They have the option to refinance or sell. The reason why this is a major issue is because this massive refinancing, so let's assume we decide to refinance, is really colliding with a very fragile fiscal situation that we currently have going, because the US debt is expected to exceed 1.6 trillion between now and 2026. Currently it's about 8.95, almost $1 trillion already. So if we decide to refinance at an higher rate, that will increase it significantly. Based on some economists, they are assuming that this will lead to about an additional $230 billion on what we currently pay. We're already paying 1 trillion, so add 230 billion, that is about almost $1.250 billion right there. And that is a very significant amount, because if you're taking the entire debt, how much deficit we have. Let me roll back again to some things that we discussed the previous time. How does US make their gross income? How do they make money? And what are they spending those money on? The US generates money from different ways. One, from personal income taxes. Almost 50% comes from personal income taxes, and about 35% from the Social Security, Medicare taxes. Then about 11% comes from corporate taxes, and that is how the US makes its revenue. The total itself is known as government revenue, which in 2024 it was about $4.9 trillion. But you know what is bigger? The amount that the government spent, which is about $6.75 trillion. It means that we are spending more than we are getting. We got about 4.92 trillion and we are spending about $6.75 trillion. We're owing about $1.6 trillion, and part of that debt is for us to service the loans that we are collecting from people that are buying our treasury bonds, and also part of it is for the defense, part of it is for the Social Security, and part of it is also for Medicare and all that. So that is what the US uses the money for. So the deficit alone on our debt is significant because majority of it is going to be attached to servicing our loan, which really doesn't make sense. We're making money, but majority of it is to pay debt, and that is a big deal. And we're already saying it's a problem because it's almost at 1 trillion, and if we have to refinance 9.2 trillion of what is almost due, that is significant because it's going to give us another deficit of 230, just like I earlier mentioned. So why does this matter to you? It matters to you and to everyone because we refinancing this debt might come at a very expensive or higher rate. This will lead to an increase in the cost of borrowing. If the cost of borrowing is high, it will lead to more deficit. That means we'll owe more. That means our GDP might not be able to take it on. So this is a big issue. Another thing again is that an higher treasury yield could disrupt the treasury market and equity valuation. Sadly, this might lead to countries or investors to start questioning the stability of the US fiscal policy, and that is not good. So as an investor, what are the risks you need to watch out for? One, interest rate risk. If US decide to refinance this debt based on the interest rates that we have currently, which is 4.5% to 5%, it will lead to elevated yield, and it will affect those bondholders with long duration. It will reduce the value of their bond and create a lot of losses. That will be one of the effects if we decide to refinance at this current rate. The second one is inflation risk. So if confidence erodes or deficits widen further, inflation expectations could rise, which will impact returns across asset classes. The third one is liquidity risk. Foreign investors or institutions might not be willing to absorb all of the new debt, which will force the Fed or domestic investors to step in. And that's not what we want to do. If the Fed steps in, that means they will print a lot of money. You know what happened just recently, 2020? This will bring about massive inflation. We don't look at a case whereby the federal government steps in, because if they start buying those bonds, that means they'll have to print more money, and printing more money devalues the dollar. And not just devalues the dollar, it creates a lot of inflation. We just experienced that recently. And the fourth one is crowding out. What does that mean? This just means that the federal government borrowing could start competing with private sectors. This will push up rates and will start slowing down businesses in the economy. So now, what is really the issue? What kind of red line or gray areas or tightrope is the Fed currently working on? Because like I said from the beginning, there is no fire without a smoke. There's a reason why this administration is pushing the Fed, which is the federal government, to reduce the interest rate because of these things that will soon be due. Now, what kind of tightrope is the Fed currently working on? Because if I were the Fed, I really don't want to be in this kind of situation. So let's go through what exactly the Fed is kind of battling with at this point. One of it is that the Federal Reserve is in a bind. Another issue is that if they decide to cut down rates to absorb these monetary fiscal issues that are happening, this might lead to high inflation rates. So we know that the Fed keeps rates high to prevent or to protect against inflation rates, but in reverse, it amplifies government debt service burden. Already, it was projected to exceed $1 trillion. Right now, if you add the additional one that will come on if they refinance based on this current rate, it's going to be largely very significant. And this is according to the Congressional Budget Office, CBO. So these are verified numbers. There might be a lot of pressure for the Fed to step in, either by slowing down the balance sheet reduction or by introducing quantitative easing. This current administration is looking at the Fed to reduce the interest rate to accommodate the refinancing burden that will come up. But I want you to know this. Yes, the Fed can play a major role in that. However, the Fed is an independent central bank with a dual mandate. They only have two mandates: control inflation and support full employment. That is their two major mandates. So this other one is not really their mandate, but they might just be pressured to do it. So let's keep an eye and see what is actually happening. So I've said a lot of things. Aside from the debt coming due, the Fed is working on a very tight rope. So as an investor, how do you navigate this entire problem? Because it's a major problem. So let's go through them one after the other. Number one thing is, if you are into bond buying, shorten your duration. Don't go and take a very long duration because of these things that are happening. It might lead to significant losses. So you want to shorten the duration of your treasury bond that you're taking for now until we see what is actually going on. The second one, this is one of the options. You need to diversify globally. This is because of what all this will do to the US dollar. I'm not saying that the US dollar will crash. Right now, the US dollar is the number one currency that we know, and that's where the global world invests in. But all these things happening could have a significant impact on the value of the US dollar. So another way you need to just do it is for you to hedge the effect by investing globally. This might help you reduce the impact on the US dollar. The third one is prioritize cash flow. I've always said this and I will keep saying it. Stop investing in assets that do not cash flow. My people, please invest in assets that cash flow. And you know that asset, multifamily is one of them. It produces consistent cash flow and also appreciate. But I don't want you to depend on promise. Appreciation is a promise. Cash flow is now. A property that will cash flow should start cash flowing now. A stock market is a promise. You don't want to put all your life savings, especially given the picture. I've been taking out time to really talk about the macro market. And the more I dig deep and I do my research, the more I cannot help it by always telling people, this is not the time for you to gamble with your life and money. This is not the time for you to start investing in things that do not cash flow. So you need to start investing in assets that produces consistent cash flow. And multifamily is one of them. If you're looking for how you can start your multifamily journey, please contact us. Our link will be in the description area for you to reach out to us on how you can start your multifamily journey. Another way you can navigate this as an investor is maintain liquidity. Given the situation, it's important that you keep reserve because of what is happening in the economy. You don't want to be in a situation where you don't have liquid to do things or make some right move or strategic decision to help you when the market overreacts or when opportunity rise, because all these things I've mentioned will give rise to many opportunities. You want to position yourself when those opportunity comes, you'll be able to grab it. You also need to watch the budget debate. The Congress will be discussing now about the budget. In short, they've been talking about the budget since. You need to constantly focus on it and know how you can navigate the entire process, because this will direct investment decisions and create some consequences. So it's important that you watch out what the Congress is talking about the budget. Very important. So my final thoughts on this, I'm going to conclude by saying that the US is in a major crisis, and this year 2025 will test the US government's ability to navigate a record high refinancing, a rising debt loan, and also a strained budget. For investors, it's not a time for autopilot strategies. No, this is a time where you have to be very cautious of the strategies that you are doing. That is why we are taking out time to inform you about what is currently going on behind the scene. So sometimes when this administration is doing something, I always go back and sit down and say, there's no fire without a smoke. What is actually going on? It was when I noticed that the federal power to reduce the interest rate just a few weeks back. I was like, there's something fishy. So I went back and I did my research and I found out that, oh, I get it. $9.2 trillion is about getting due. And if they refinance at this point in time, it's going to be a massive burden, massive problem for the US debt. It just tells us why some things are happening. So you need to look above what you see and go deeper and make some research and find out what exactly is actually going on in the US, because there's a lot of distractions, from immigration to tariff to job loss, federal employment court, so many distractions. But we are forgetting to understand that there's a major problem, which is the US debt, which can impact the entire thing that we are doing. So it's important that as an investor, like I said, it's not a time for autopilot strategies. You need to every time fine-tune your strategy to accommodate or to navigate this entire period, because for some of us, it's like the first time we're experiencing this, and this is the highest debt. Like I said before, 36.2 trillion is the highest US debt that has ever been, ever. So it's a new terrain, it's a new environment for so many of us, and it's important that you are very strategic, and this is a period for you to also be flexible, have liquidity, and position yourself for resilience. This is a period for that. But in moment of fiscal stress, which the country is currently in, the line between the monetary independence and fiscal coordination might seem blurred. We don't know what that will look like. We don't know how they are going to handle that. So I just want to end by saying that listen to exactly what is going on in the economy. Watch out for what the conversations that are going on in the Congress. They're currently talking about the budget. They're talking about taxes. So many things are going on. Please listen to it, because as an investor, you don't want to invest without having your tools or understanding where the economy is going to. You need to put that into right perspective and decide on the right investment for you to do. If you've enjoyed this, I need you to like, subscribe, and share this video. You will do us great if you do that. We're happy to always do this, but if you do not share, or you do not like, or you do not subscribe, how do you think we'll have the morale to continue doing all these videos? It takes us time. We have to do our own research. I don't come out here to do videos without doing my own study or my research. I do a lot of that so that I can give you the right knowledge and the right advice and comments for you to be strategic in your investment, because that's the main goal here. That's the main goal, not politics. The effect of politics on our investment. I look forward to seeing you in my next episode. Thank you.